S&P 500 futures are grinding up a fraction this morning. Nasdaq 100 futures are clinging to a 0.4% gain. But if you look at the overnight flow and the institutional briefings, the actual sentiment is incredibly defensive.
The tape is defensive because the macro catalyst is completely overriding the surface level technicals right now. We have a ninth consecutive night of U.S. military strikes against Iranian targets.
9 nights takes this well out of a localized event category. Looking at the immediate execution data, tanker traffic moving through the Strait of Hormuz has essentially flatlined.
Right, and the structural reality you have to price in is that roughly 20% of the world's global oil consumption passes through that specific geographic choke point. When that physical bottleneck closes, the paper market panics instantly.
Which is exactly what we're seeing in the spread this morning. Brent crude is spiking near $91 a barrel. WTI is holding right near 82. And with energy costs spiking amidst that uncertainty, capital is just fleeing into hard defense. Spot gold is sitting comfortably above $4,000 an ounce right now.
I mean, focus on that $91 level for Brent. That is a critical psychological and mathematical threshold. It is the exact point where institutional inflation models start flashing red for the next quarter.
But look at the divergence in the sectors. Energy is catching a massive bid, gold is surging, but the technology sector is structurally bleeding overnight. Look at the Asian session. South Korea's Kospi index plunged 4.5%.
The Kospi is the canary in the coal mine for global semiconductor demand. And the real risk here isn't just geopolitical, it's the unit economics of AI.
Right, because over the weekend, China's Moonshot AI dropped a brand new open source model, Kimi K3. Just that single release triggered the absolute shockwave in the Asian semiconductor markets.
Because that release slams into a global semiconductor sector that was already incredibly vulnerable. We are currently sitting in a 20% technical bear market correction from the June peak in the chip sector.
A 20% drop from the highs is a structural reassessment of value, not just a bad week. But you have to connect the dots on the order flow. Why does one open source model out of China cause global chip makers to lose a fifth of their market cap?
It's a monetization crisis. The market is looking at the tens of billions of dollars being poured into these massive data centers, the sheer volume of silicon being purchased, and institutions are asking when the software companies actually turn a profit on that capex.
And when a highly capable open source model like Kimi K3 drops for free,
It completely destroys the protective moat of the established closed model players.
if the software is suddenly free, the massive capital expenditure to build the infrastructure looks like a terrible investment.
Exactly. The entire profit model is thrown into question. If AI software becomes commoditized, the endless demand for next-generation semiconductors suddenly looks like a massive bubble.
But look at the options flow in the futures tape. The Nasdaq 100 futures are actually up slightly this morning. If the semiconductor space is in a 20% bear market and open source AI is threatening profit margins across the board, retail is going to look at this morning's green tape as a classic dip to buy.
If you're trading purely on muscle memory from last year, sure. But the structural data paints a completely different picture today. The institutional positioning describes today's setup as a classic liquidity trap.
Break down the exact mechanics of that trap. What makes the order book so dangerous today?
You have to look at the structural divergence between the two major indices. Start with the S&P 500, the ES futures contract. It is currently maintaining what technicians call a macro ascending triangle.
Meaning buyers are consistently stepping in at higher and higher prices, raising the floor.
Yes, it creates a rising level of support, which is generally a bullish pattern provided it holds the horizontal floor. For the S&P today, that institutional line in the sand is between 7,425 and 7,435.
That's the exact zone where institutional buyers have repeatedly defended the trend.
Right. And if the bulls lose 7,425, the 50-day moving average is broken, and that opens a very swift correction path down towards 7,100.
But the Nasdaq is carving out a totally inverted setup.
A completely inverted story. The tech-heavy Nasdaq 100, the NQ contract, is in a descending triangle. That is classically bearish. Sellers are getting increasingly aggressive, pushing the highs lower and lower, fading literally every attempted bounce since late June.
So the S&P is being squeezed upward by institutional buyers, but the Nasdaq is being squeezed downward by sellers.
And that divergence is the trap. It locks broader market prices within incredibly tight, brutal intraday ranges. Heavy leverage and institutional profit-taking mean that if retail traders try to chase breakout candles in either direction today,
They will get chopped to pieces by the opposing macro force. The S&P wants to rally, the Nasdaq wants to sell off.
they cancel each other out.
So where does the floor actually fall out for the Nasdaq today?
The ultimate defensive firewall is 28,400. A daily close below 28,400 triggers a major bearish breakdown, exposing the early June swing lows. But listen, staring at intraday charts won't resolve this range. The catalyst that will finally smash this liquidity trap open is going to be mega cap earnings.
Specifically Alphabet on Wednesday.
Exactly.
So we have this gridlock on the broader indices, but capital still has to flow somewhere. Looking at the pre-market gappers, the battlefield is forming in very specific individual names. Let's pull up Alibaba, ticker BBF.
They had the most aggressive corporate response to the weekend's open source news.
The stock is gapping up 5% pre-market, trading right around a 120. They countered the moonshot AI threat by previewing their own flagship model, Quinn 3.8 Max,
It's a 2.4 trillion parameter model.
which is roughly double the size of the flagship models making headlines just last year. It is an exponential leap in computational reasoning. But the parameter count isn't even the actual catalyst for the pre-market gap.
No, the distribution channel is the real institutional catalyst.
Right, China's Cyberspace Administration just approved integrating Quinn into Apple's iOS and iPadOS. That gives Alibaba a massive consumer device footprint right in the palm of millions of users in China.
It immediately transitions them from an enterprise and e-commerce play to the dominant domestic consumer AI interface. The geopolitical reality is that Apple needs a compliant domestic partner to navigate cyberspace regulations in China. Alibaba winning that integration is a monumental shift for their data acquisition pipeline.
Let's explicitly define the technical levels on BS.
For the bulls, they absolutely need to break and hold above 125. That is the long-term technical resistance zone where previous rallies have historically died.
Breaking 125 signals actual institutional conviction, not just a retail gap and crap.
It validates a full-scale trend reversal. However, if domestic AI competition or the macro headwinds we just discussed cause a broader market sell-off today, you have to watch 116.66.
That's the current 50-day moving average.
It must hold to keep this immediate recovery structure intact.
But look at where capital is hiding when it actively flees the tech sector entirely. Let's look at Fervo Energy, ticker FRVO, also up 5% pre-market.
Jefferies just upgraded them from a hold to a buy, slapping a $34 price target on it.
They are an enhanced geothermal developer. Jefferies noted the recent 40% pullback from post-IPO highs makes it an attractive entry point, especially since they just hit a major drilling milestone on their Sawtooth 7 well.
Fervo is a critical case study in relative value right now.
But I have to stress test this premise. How is a pre-profit, highly speculative geothermal developer a safe haven in a high interest rate environment? Geothermal requires massive upfront capital expenditure. When yields are sitting at 4.5%, CapEx-heavy infrastructure projects usually get taken out back and shot.
You're entirely right that high yields punish CapEx-heavy projects. But you have to consider the alternative relative safety. Tech multiples are contracting rapidly. Meanwhile, we have a literal physical bottleneck in the Strait of Hormuz pushing Brent crude to 91.
So it's a direct play on energy independence.
Exactly. In this specific environment, capital rotates into Fervo and domestic energy in general as a defensive geopolitical hedge. When the global supply chain for fossil fuels is under active military threat, any domestic alternative energy infrastructure that proves it can execute.
Which the Sawtooth 7 milestone demonstrated.
Right. It makes them look highly attractive to institutions desperate to part capital away from the semiconductor bloodbath.
What are the downside risk levels on Fervo?
The Jefferies target is 34, but on the downside, the absolute must-hold support is 23.11. If we break below 23.11, the market is signaling that the heavy capital expenditure demands are just too toxic for the current rate environment, completely regardless of the geopolitical hedge.
Before we move off individual names, there's one highly anomalous bright spot outside of tech and energy. Yeti Holdings, ticker Yeti. Goldman Sachs just upgraded them to buy with a $63 price target.
It's a consumer discretionary stock surviving in a highly defensive risk-off market.
which is structurally hilarious. The Strait of Hormuz is functionally closed, chip stocks are plummeting, yields are elevated, but the American consumer is apparently making absolutely sure their camping coffee stays at exactly 140 degrees.
It speaks to the psychological resilience of the high-end consumer, but it is an outlier. The Goldman note points to incredibly tight inventories and strong retailer restocking.
The supply chains for these specific luxury goods have normalized, and demand hasn't evaporated.
Right. It proves that brand momentum and clean execution can still attract capital. But to truly understand why the broader tech sector is struggling while energy and value stocks thrive, we have to look away from the equity charts entirely. We have to look at the bond market.
The silent killers in the background, let's deliver the hard numbers. The 10-year Treasury yield is ticking up this morning to 4.56%, and the U.S. dollar index, the DXY, is holding incredibly firm around 100.75.
That combination creates severe mechanical multiple compression for tech stocks. It's a headwind the sector simply cannot ignore.
Break down that multiple compression for the order book. When the guaranteed risk-free rate goes up to 4.5%, a startup's 10-year vision suddenly looks a lot less appealing.
It's far more severe than just psychological preference. It's structural mathematics. The discounted cash flow models that institutions use to literally price these stocks automatically downgrade the present value the second that 10-year yield ticks up.
Because tech stocks are long-duration assets. Their valuations are heavily based on cash flows projected 5, 10, 15 years out.
Exactly. To figure out what those future dollars are worth today, you have to discount them. The discount rate is based on the risk-free rate, the 10-year Treasury yield.
So when the 10-year yield spikes to 4.56%, the mathematical discount rate rises.
And the algorithmic models automatically reduce the fair value of the stock. Instant multiple compression. Institutional investors will not pay a high multiple for future growth when they can get a guaranteed 4.56% yield today, risk-free.
Today's tangible earnings in sectors like energy and defense become mathematically worth more than tomorrow's promises in tech.
And then you add the currency headwind. The U.S. dollar index holding at 100.75.
How does that specifically hit U.S. technology multinationals?
A strong dollar acts as a massive headwind because it shows global money flowing into the U.S. as a safe haven. But if you are a massive U.S. multinational, an Alphabet or an Apple, you sell a huge percentage of your products overseas.
Right, you're selling in euros or yen.
And when you convert those foreign currencies back into historically strong U.S. dollars on the quarterly earnings report, your revenues instantly shrink. It is a direct mechanical hit to the balance sheet.
Yields are up, mathematically crushing future tech growth, and the dollar is strong, crushing current overseas tech revenue. It's a brutal pincer movement on the entire sector, and the Federal Reserve is not coming to the rescue.
Not based on Cleveland Fed President Beth Hammack's recent warning. That is front and center in institutional minds today.
She explicitly cautioned that inflation remains stubborn, and the path to a 2% target is completely not guaranteed.
Which forces the market to rapidly reprice expectations. Retail traders have spent months buying tech dips under the assumption that the Fed was about to cut rates aggressively and bring back easy money.
But with Brent crude near 91 due to the Hormuz bottleneck, you have sticky commodity inflation being injected right back into the global economy.
The Fed cannot responsibly cut rates when energy costs are spiking. The market is actively pricing out those near-term rate cuts as we speak.
Synthesizing the entire board, the geopolitical tension, the AI open source shockwave, 4.56% yields, and a stubborn Fed, what is the actual execution play here?
It's what institutions refer to as the pain trade.
The market moving in the exact direction that inflicts maximum financial damage on the majority of retail investors.
Right. The reflexive move for a retail investor logging in, seeing tech down 20% from June highs, is to just buy the dip. They buy highly speculative zero-yield tech, expecting a V-shaped recovery based on assumed rate cuts that are no longer coming.
But the pain trade is a massive structural rotation out of that.
While retail buys the tech dip, institutional capital is rotating heavily into value, energy, and defense. Institutions understand we are in a higher-for-longer reality on rates. With short-term cash yielding over 4.5%, large funds simply do not need to take on the risk of chasing overvalued tech multiples.
If you're positioned heavily in speculative tech right now, expecting a bailout, your capital is trapped.
It's dead money. The macro environment strictly favors cash, hard assets, and immediate profitability over future promises.
So the line in the sand is clear. Do not fight the tape, and absolutely do not ignore the bond market.
Yeah.
If the 10-year yield is screaming that rates are staying high, Respect that gravity.
You have to. But the real risk here isn't just a missed earnings print or a broken support level. Looking at the structural shift, you have to ask a much larger question.
Where does this macro collision actually lead us?
If we are entering a phase where artificial intelligence is advancing exponentially faster than any technology in history, but the macroeconomic gravity of 4.5% yields and global conflict makes investing in it actively dangerous for the everyday trader.
The technology thrives, but the equity is toxic.
Exactly. You have to ask, are we witnessing a fundamental decoupling between human innovation and financial reward? If the greatest technological leaps of our generation are currently classified as dead money by the algorithmic models of the bond market, perhaps we need to completely rethink how we value the businesses building the future.
That is the thought to sit with as the bell rings.
Yeah.
Keep your eyes on Alphabet's earnings this Wednesday. Respect the ES floor at 7,425. Watch the NQ defense at 28,400 and stay sharp.